Greetings from ADK Wealth Advisory Group in St. Louis. It's my pleasure to present to you the first quarter 2015 market update. Our focus is going to be around financial market and economic cycles. Well, I'd like to use a football metaphor since we just played the Super Bowl. A baseball metaphor is more fitting. And as you recall from our market video 2014 fourth quarter, I defined the different parts of the cycles: beginning, middle, end, and then decline. I think we've began the end stage of the market cycle. And how you can kind of see that is you see corporate earnings, GDP numbers still going up on the average, but going up at lower rates. So you'll start to see countries and companies lowering forecast, missing their stated consensus numbers. And so what we'll do is we'll go across the pond and look at a variety of different countries and some of the key stories. But as we were talking about, probably a baseball metaphor is better. I believe we're in the ninth inning of the game. With baseball, you really never know, is it going to be a short ninth inning, is it going to be a long ninth inning, or will we even go into extra innings? And those parts of this particular chapter are yet to be written. Our first stop around the globe is Europe, and I think the two key themes of the story, quantitative easing and Greece. It's a sad reality when the developed world has positioned itself where quantitative easing is needed. But I do believe in Europe it's the right strategic maneuver at this stage. So in January of 2015, the ECB, the European Central Bank, finalized its plan and worked through all the political structure to be able to have 60 billion euros a month through September of 2016 as a minimum. And that exceeded what the consensus was on the street, and the financial markets really liked the move. When you take a look at the benefits of it, because quantitative easing in real terms means you're printing money, it debases or devalues your currency, which is significant for Europe right now because if you take a look at their GDP, their economy, 44% of their economy is exports. You compare that to, say, the United States, which is less than 15%, or Japan, which is less than 20%. It doesn't take a rocket scientist or even an economist to figure out that lower exporting prices helps Europe. The other thing it does is when your currency goes down, it makes the things that you're importing in cost more, which creates inflation. And believe it or not, right now, that's a good thing in Europe because they're teetering on the brink of deflation. And deflation is one of the ugliest economic scenarios to experience. All of those things present themselves in what I would classify as a real strong tailwind helping them. But then on the other side, they have this headwind of Greece. You can't turn on your television or open any kind of media to be able to avoid seeing what's going on with Greece. And you could summarize Greece like this. Their debt load is almost twice as much when you compare it to their economy and size than all of Europe combined. So they're at 175% of debt to GDP. To say that that's pathetic is probably an understatement, but yet the new leftist regime wants and expects Europe to say, we borrowed $1 from you, but we're going to pay you some lower amount. And so there's this posturing going back and forth that creates an enormous amount of uncertainty, thus the headwind statement. In the end, what we really don't know is what will happen there. We also don't know, will that create dominoes where Italy or Spain, more significant countries, will try to do the same. In summary, I think you could say that Europe has a balancing act right now between quantitative easing and Greece, and no one really knows how that will turn out. It's my opinion that in the short run, Greece will create a lot of volatility there, but that the quantitative easing will exceed the pressure from that. But in the end, a longer-term outlook for Europe is not favorable. Short-term positive, long-term negative. When we move away from, say, Europe and go to China, you have some interesting things. Again, some main storylines would be real estate. It would be localized debt. And so if you take a look at real estate, Last year, December's real estate report for China showed the residential real estate going down 4.3%. That kind of drop started at the beginning of 2004 and has gone on. It's my opinion from reading articles in the Financial Times that that is highly probable to continue throughout 15 and maybe even throughout 2017. And that's significant because about 25% of China's economy is made up of this residential building and then the ancillary businesses that come along with that. And so what you end up seeing is something that's different in China than here is their local governments are really reliant on these transactions because they're the ones who basically confiscate the land and then transition it and develop it. And they make a lot of money from that transition and development, and a lot of the revenue that they're dependent on is from these deals. When you take a look at that, if you have prices going down because of excess building, you're going to have fewer deals going on, so that hurts them. The other thing that they're experiencing is that they've been borrowing money at these local levels at some pretty exorbitant levels. For example, in 2014, the local governments borrowed a total of 1.6 trillion renminbi. If you compare that to, say, 2013, 2012, it was more like 900 billion. So some really big numbers. And in this calendar year, they have about 1.5 trillion renminbi debt maturing. Now, in most cases, I would say that that could be really catastrophic. To me, for China, it's more of a large speed bump because the government has so much reserves that they can buy themselves through some of these problems. But what it really does is it becomes a drag on the economy. So, for example, when you take a look at the economic GDP forecast, it used to be that they were growing at 9 to 12% as a country, and now their forecast is more like 7.5%. But last year they came in at more like 7.3%. And when I read different articles, it's hard for me to imagine that they're able to do much more than low sevens. When you really summarize it, real estate and localized debt are problems for China. But what's going on in Asia from a long-term perspective is almost unstoppable. I think they'll go through much like what the United States went through post-World War II, where you have growth spurts that have excess like we're seeing right now. They'll have to digest through that and continue to work on. But because of that, what I'll classify as real estate slowdown, it affects commodity prices. And then you have economies like, say, Russia, Brazil, Venezuela, Australia, Nigeria, that are very oriented towards commodity, whether it's oil or minerals. And so as China slows down, some of these other countries get hurt. When you take a look at Russia, we all know about what's going on in Crimea. And Russia is, according to the New York Times, on what I would classify as a race against time. Specifically, they have about 385 billion rubles in reserves, but oil prices and sanctions have really positioned it to where their economy is projected this year to slow to a drop of a 4% negative. On top of that, because the ruble has plummeted so much and because of sanctions, their inflation rate last year was about 11%. You could summarize Russia as that they're in a dogfight right now, that they need oil to come back up, or they're going to need a lifeline from China. My bet would be against Russia. Hard to say how China will play into that, but in the end, Russia's in a miserable situation. When you leave Russia and you go over to, say, Australia, Australia is in a situation where, because their economy is so predicated on exporting commodities, ores, minerals, etc., to China for their building, as China slows down, Australia gets hurt. They've actually experienced the first real drop in wage income per capita since like the early 1990s. If you really chart things out, you can see that the early 1990s, China started to take off. China slowing down, Australia slowing down. A key bank, the ANZ Bank, lowered its forecast for 2015 from 3% to 2.5% GDP. So the general theme that you're seeing here is, other than Russia, you're seeing economies growing, but growing at lower rates than what was forecasted, which is very exemplary of what goes on inside of the ninth inning, if you will. I'll close with the United States. If you take a look at the United States, oil has been really this huge storyline. It doesn't take an economist to see what's happened, that oil's gone above 100 a barrel to below 50. And according to the LPL's research department, approximately 8% of the S&P 500 companies are made up of energy related. And so their earnings get crushed. But the other 90+% of the companies benefit from lower energy prices. But there is a trickle through and there is a market fixation. The trickle through is banks, your real large banks, are involved in lending money so that a lot of these capital projects that are going on within the different basins, whether it's the basin in the Northeast or down in Texas or up in the Dakotas. And as oil has dropped in price, some of those projects have stalled, some have been canceled, some are just slowing down. And so fees that banks generate from lending money to this has dropped as well. And so that extends itself beyond that 8% of the S&P into the financial service as well. All in all, though, I think that the market is fixated on something that is negative, whereas I think the net positive of this is that you see consumers and a lot of companies benefit from lower energy prices. All you have to do is take a look at the price that you're paying at the pump. I know for me it's gone in half, which that money translates into other kind of consumer spending. The second key story within the United States really is around deficit spending. During the Obama administration, a very favorable outcome has been that deficit spending has been cut by about 2/3. The other thing is that now puts us in line, deficit spending compared to our economy, to like our 50-year average. So in that respect, things above the line sort of seem favorable. But when you look below the surface, both political parties, the Democrats and the Republicans, have been guilty for over 20 years of kicking the can down the road. The can being the problem that we have as the baby boom, which is kind of defined by people who were born 1949 to 1964. As they are now approaching retirement age, we have 10,000 a day hitting retirement age. Doesn't mean all of them retire, but 10,000 a day is a big number. When you take a look at the pressure that puts on Social Security, Medicare, and Medicaid, it's staggering. The market video update Rich Karowski did last year on these subjects is something that I would recommend that you go to discoverindependence.com to revisit for more details. I would summarize it by saying that the Congressional Budget Office, when you look at their statistics of what's to happen over the next 15 years, inside of that window is nothing other than staggering. If we don't have major reform, we'll be the largest insurance company in the world with an army. Yes, the largest insurance company with an army. We're in a position where underneath the surface reform has to happen. In closing, we're metaphorically speaking in the ninth inning of the business / financial market cycle. Hard to say whether that's a short inning, a long inning, or whether or not some things like Europeans' quantitative easing causes us to go into extra innings in a favorable way. If I were going to put that in layman's terms, I think 2015 we should expect increased volatility in the financial markets, but with positive returns. It's the intermediate term period that you've heard me speak about, that 2016 to 2020 window, where excessive debt throughout the developed world governments has me really concerned, so I'll categorize that as elevated risk. And then 2020 and beyond, because of things like the energy renaissance that's pushing energy prices down, as well as the formation of the middle class in Asia, those things cause us to be very bullish. And we'll talk in more detail when we have our upcoming meetings. I want to take a minute just to cover a housekeeping item with you, and that is that if these videos have been enjoyable for you and if you like them, Discover Independence, we have them archived all the way back to when we piloted them in 2013. I would also like to ask you, if you haven't already, to connect with us in social media. Facebook's probably the best way. We also are doing LinkedIn. If you've already connected with us that way, thank you very much. And if these are valuable to the point where you would share them with people that you care about, we cherish any type of referrals that you would have. Thank you very much for your time. Thank you for your business, and thank you for the trust and relationship that we've built over the last 26 years together. Farewell from St. Louis.